Costco. You go in for paper towels, you leave $900 lighter. Holding a kayak. Everybody loves this company. 9 in 10 members renew every year. The stock's near its record high, and Wall Street treats it like a sure thing. Here's the catch. At today's price, you're paying almost $50 for every $1 the company earns in a year. So which is it? The best business in retail, worth every penny, or a great company at a price that's not so great? Let's scout it. This one's a battle between two ideas. It's the best, just own it, versus great, but not at any price. So we'll do it in 4 moves: meet the business and the one growth number that's actually up for debate. Run the health check. Then the big one, is the stock cheap or expensive really? And finally, the chart. The meter fills in as we go. The final call waits till the end. And the ground rule never changes. And this is information, not advice. You make the call. So, who is Costco? On the surface, simple. Giant warehouses, a members-only club, a short list of products, about 4,000 items, where your normal grocery store carries 50,000. All sold in bulk, cheap. 933 warehouses now, around the world. But the low prices aren't the clever part. The clever part is how Costco makes money, and it's kind of beautiful. Watch this. Costco sells the actual groceries at barely above Costco. The stuff on the shelves, almost no profit. The money is the card in your wallet. That yearly membership fee is nearly pure profit. And it's what pays for the low prices in the first place. Think of a gym or Netflix. You pay at the door, then you get the goods at Costco. And people keep paying. Membership fees rose 11% last quarter to about $1.33 billion. Almost 83 million paying members. And here's the one that matters. In the US and Canada, 92% of them renew every year. That's the flywheel. Cheap prices keep members loyal. Loyal members pay the fees. The fees pay for the cheap prices. Round and round it goes. Now, why is it in the news? Its latest sales. And this is where you learn to read Costco like an analyst. In early July, Costco said June sales were up 10.5%, big number. But that headline hides 2 moving parts. Take out gasoline prices. Take out the swing in foreign currencies. Both can move the reported dollars without anyone actually buying more. Strip those out, and the cleaner same-store number was 7%. Now, 7% is still good. Don't let anyone call that weak. But the gap between 10.5 and 7, that's the real question. How fast is Costco actually growing underneath the noise? Hold that thought, because you're about to pay a very big price for the answer. A great machine, loyal members, a self-funding flywheel, real 7% growth. So, is the engine under the hood as healthy as it looks? Before I care about the stock price, I run the business through a quick health check. Think of it as a physical, a few vital signs. Before I show you the grade, what would you guess? A B, 71 out of 100. And the label the model puts on it? Good business. Watch the valuation. Hold on to that second half. It's the whole back half of this video. First, let's see why it earns the good. Start with Costco's best number. It's called return on invested capital. In plain English, it's the company's report card. For every dollar it puts to work, how much does it earn back? Over 10% is genuinely good. Costco runs around 22-23%, and it's held that for a decade. 1 year, 3, 5, 10, all green. Honestly, that number's a little nuts for a company selling $5 rotisserie chickens. This is an elite money machine. Clean bill of health. The balance sheet's a fortress too. Full marks on debt relative to the cash it throws off, and positive free cash flow, real leftover cash, every one of the last 10 years. So this is not a fragile company, not even close. So where's the yellow flag? Right here. The model dings 2 things. Revenue growth and earnings growth are, in its words, trending down. Let me be fair about what that means because it's easy to misread. Costco isn't shrinking. It's still growing revenue around 8%, earnings around 10%. But the fastest days are behind it. 5 years ago, earnings grew closer to 15%. Now it's high, single digits, low double digits. That's not decay. That's just a giant getting bigger and naturally a little slower. File that away, because in about 3 minutes when we hit the price, that one number matters more than anything else. Quick footnote while we're here. The model gives Costco only half marks on its share count, meaning it's not aggressively buying back its own stock the way some cash machines do. Minor, doesn't change the story. Elite returns, a fortress balance sheet, 10 straight years of real cash, a genuinely high-quality business. With one yellow flag, the growth is quietly slowing. On quality alone, that's a green. Okay, great business. Now the question that decides everything, is the stock cheap or expensive? And Costco plays a mean little trick on you here. Watch, trick number 1. Compared to how Costco normally trades, it looks fine. The stock's at about 47 times next year's earnings. Its own 5-year average, about 45. So versus its own history, this is basically normal. And this is exactly where most people stop. They shrug and say, hey, Costco's always expensive. It's fine, but always expensive and worth it are not the same sentence. So let's do the math that actually tells you what you'd earn. Here's how the model values it. It takes Costco's expected future earnings. It runs them through a bad case, a middle case, and a good case. Then it asks one question. At today's price, about $974, what return can you actually expect for the risk? The model wants 12% a year to make that risk worth it. That's the hurdle. So what does today's price pencil out to? About 6% a year. 6 against a hurdle of 12. Its risk-adjusted value lands near $557. The stock's at $974. In plain English, you're paying up front for a lot of growth that hasn't happened yet. At this price, it'd take about 15 years of earnings just to pay you back. No. So, this is not a target, not a sell, not some price it's going to hit. It's an odds read. And right now, the odds are stretched. And now, the number that actually stopped me. The model runs 3 futures, one ground rule first, so nobody misreads this. Those 25, 50, 25 splits are planning weights, how much each future counts in the math. They are not your odds of making money. Okay, the middle case, Costco grows about 10% a year, keeps growing near 10 and holds a rich multiple. You'd make about 6% a year. The bad case, growth slips to the low single digits, the multiple cools, and you'd actually lose a hair each year. And the good case, growth around 12%, and even richer multiple, you'd make about 10% a year. Okay, jokes aside, this is the part that decides it. Even that good case lands under the 12% the model wants for the risk. Sit with that for a second. On this model's deliberately demanding assumptions, your best outcome still doesn't clear the bar. That's what priced for perfection really means. You're paying so much up front that even things going right doesn't pay you enough. One honest caveat, because I always hold both sides. That whole read leans on the growth estimate. Analysts have Costco's earnings growing a little under 10% a year, and we refresh that number before every video. So if Costco reaccelerates, a bigger membership base, a fee increase, international finally clicking, the math improves and this picture changes. The model runs that near-term estimate for its stated window, then a slower, steady pace after. Nobody should just paste today's growth across a whole decade. And this isn't just one model's opinion. There's a second old-fashioned way to check. Value Costco on the earnings it's already reported. Now that's a historical cross-check, not the headline read, but even its generous version comes out overpriced. Different lens. Same answer. The stock is expensive on today's numbers. The only way it's cheap is if you're confident in years of flawless execution ahead. The twist, normal versus its own history, expensive versus what you'd actually earn. Even the upside case misses the hurdle. Price posture, wait, the one thing that would flip it, growth speeding back up. So elite business, stretched price. The chart's the tiebreaker. What is price actually doing? No story, no opinions. And here it gets interesting because the chart and the valuation flat out disagree. Three things: trend, structure, momentum, first, trend. These two lines are the 50-day and 200-day averages, just the average price over the last 50 and 200 days, a way to smooth the daily noise and see direction. The longer line is the slow one, the big picture current. Costco at 974 is sitting above both. The fast line above the slow one. That's an uptrend, plain and simple. Second, structure. This is a point-and-figure chart. Ignore the X's and O's. It's just a filter that marks the real moves and throws out the daily wiggle. Its read: a rising column, a buy signal, support down around 940, resistance right overhead at 990. So trend and structure agree. This thing points up. Third, momentum, and here's the nuance that keeps us honest. On top, it looks strong. RSI, think of it as a speedometer for buying versus selling, sits around 60, healthy, room to run, not overheated. And MACD, that's just a gauge of whether momentum is improving. It ticked up too. Another green light. So far, so good. But watch underneath. The volume isn't showing up. Money flow, a read on whether buyers or sellers are really in control, is negative. And Costco's actually been lagging the S&P the last few months. The model even flags it in plain words: volume does not confirm the trend. And one more tell: trend strength is weak. A reading called a DX sitting down around 14. Think of ADX as the volume knob on the trend. Price is climbing, sure, but the signal's turned way down low, so you trust it a little less. Put it all together and picture a party that looks packed in the photos. Then you walk in and half the room's empty. That's this chart. Price is drifting up. The crowd behind it is thin. So the honest chart read constructive, leaning bullish, but not the clean, powerful breakout you'd chase. The line in the sand is simple. A close above 990, the buyers finally showed up. Lose 940s, the near-term trend rolls over. Until then, define your trade first. This is not a green light. A real uptrend above both averages, structure confirms, but light volume behind it. Constructive, not commanding. The chart leans green with an asterisk. Before the verdict, one honest gut check. Everything so far is about right now, but Costco's been public for 40 years, so we back-tested it. And the headline finding is the important part, so I'll just say it straight. Over 40 years, just buying Costco and holding it returned more than 8,000%, about 12% a year. And when the test threw every timing trick at it, oversold bounces, momentum crossovers, all of it, nothing reliably beat just holding. The model's own words: get invested and stay invested. So what you're about to see is not a buy signal, not a system, not advice. It's a back test. Hypothetical, and the past is not the future. Now what? You might be thinking, Costco's about 11% off its high, so isn't this the dip to buy? Here's the honest surprise. Historically, buying Costco on this kind of dip returned about 52% over the next 3 years. Sounds great until you learn that buying on any random day returned about 57. So the dip didn't help. If anything, a touch worse. And that's the real lesson of a compounder like this. It was never about timing the stock. It was about time in the stock, which leaves you with a genuine dilemma. Over decades, patience won, even when you paid up. But that's the past. Today, you're paying 47 times earnings for high single-digit growth. So which are you really buying, the next 12 months or the next 20 years? That part's on you. One quick zoom out before the verdict, because no stock trades in a vacuum. What's the whole market doing? The market mood gauge right now reads caution, right down the middle. Call it a yellow light. Under the hood, some genuinely good stuff. The rally's broad. It's not just a handful of giant tech names dragging everything up. Plenty of stocks are pulling their weight. Credit markets are calm, and the yield curve isn't flashing any recession warning. But here's the other side. The big indexes just slipped below their 50-day averages. Short-term momentum is fading. And the VIX, that's the market's fear gauge, basically how nervous investors are, just ticked up to 20. Not scary, but not asleep either. So the tape isn't fighting Costco hard, but it's not rolling out a green carpet either. It's mixed, which, honestly, is the same story as Costco's own chart. Constructive underneath, choppy on top, the backdrop's a yellow light, broadly healthy but losing a little short-term steam. It doesn't add any urgency here. All right, let's put it together, because this one's a clean lesson. The business, elite, 22% returns for a decade. A fortress balance sheet, 92% of members renewing. One yellow flag, growth is slowing, but it's a giant, and that's normal. The chart, honestly, fine. A real uptrend, just riding on thin volume. So if the business is great and the chart's fine, where's the catch? It's the one thing we can't wave away, the price. At 47 times earnings, the model says your expected return is about 6% a year, and even if everything goes right, the best case still comes in under the 12 you'd want. You're paying a perfect price, but for a merely excellent future. So, here's Scout's field report, and it's a particular kind of read, the kind where nothing is broken, and the answer is still not here. Costco is a wonderful business at a demanding price. The fundamentals say quality. The chart says it's holding up, and the valuation says you're paying for perfection and the odds don't clear the bar. Put those together, and you don't get a buy, you don't get a sell, you get a watch, a world-class company most people would be glad to own at a price that's asking a lot, not a chase, and you get a scheduled scoreboard. August 5th, Costco reports July sales. Watch that clean number, the one without gas and currency. Is it holding around 7% or better? Then September 24th, full year earnings, margins, membership, and any hint of a fee increase that would genuinely move the growth math. On the chart, it's simpler. A close over 990 says the buyers finally arrived. And what would flip my read from watch to interesting? One of two things. A much better expected return read. The model refreshed, the odds actually clearing that 12% hurdle, or earnings growth speeding back up, fast enough to earn the big multiple. Honestly, this is a fun one to argue about, because the "it's always expensive and always wins" crowd has a real point. So tell me, are you team valuation, each wait for a better price, or team quality? The best businesses are worth paying up for? Make your case down in the comments. I read them. That's the read. But it's a read, not a recommendation. This channel is information only, not financial advice. The numbers here are a starting point for your own homework, not a replacement for it. If this made Costco click for you, do me a favor, subscribe. We run one of these every week, and if there's a stock you want run through this exact playbook, drop the ticker below. That's the whole point of the channel.